Welcome to Our Stock Trades. In this video, we're going to be going over what Cathie Wood has said in regards to inflation and deflation. We're going to be making some economic predictions, and this will hopefully help you catch up on what is happening in the global financial markets. And you will be able to see what the big money is essentially planning for and what they're doing in this inflationary, soon to be deflationary cycle. Okay. So without further ado, we're going to get straight to business, and I'm going to essentially summarize a 45-minute video in essentially basic English and work with it in a way to help you guys as retail investors get past this one-of-a-kind market that we're experiencing. So just as a recap, Cathie Wood essentially talked about how we're obviously experiencing some economic slowing. Inflation is coming down. If you look at the core PCE, it went from approximately 5 to 4.9 from March to April. The thing is, it's going to be hard for the Federal Reserve to keep increasing interest rates. In fact, if you look at Europe and China, they might actually already be in a recession. Now, if you don't track China, they're recently doing monetary easing, which is the opposite of what the United States is doing, which is monetary tightening. Okay. And so this is essentially what's happening there. And we might even see recessions within those regions. And it's important to talk about this because this is not a United States problem. The whole global economy is connected and it's experiencing some contractions. If you look at the United States, we just got 1 quarter of negative GDP growth. I believe it was negative 1.4%. This may not be a fluke. We are speculated to essentially just have 1 month and 1 quarter, and we might get back on track. However, based off of the endpoint analysis, it may seem that right now we are currently living in an inflationary phase, which then if we move on to the next phase, it'll be deflationary. And I'm going to explain to you guys what that is. I made a diagram for you that I uploaded onto this slide set here. So if you look at, and this is a lot going on here in this section, I'm just gonna, it's easier for me to just do this. If you look at this, what will make the Federal Reserve essentially stop their tightening levels? Well, essentially, why are we asking this question? Well, we have to ask this question because as soon as the Federal Reserve stops tightening, it means one thing. It means inflation has calmed down. And once these two key components happen, which they are closely in sync together, it will allow the equity markets, the stock market, to rise, okay? So a couple of disturbing things. Walmart and Target sales were up 3% year over year. However, inflation is up 8%. Therefore, they are losing money. Target and Walmart, they're losing money and they're getting an inflationary cut. And this is why their stock prices have been reflected in their value. So inventories are rising. And this is something that Cathie Wood predicted, and I agreed with her prediction back on November if you watch my videos. As right now, a lot of incomes, retail investors, the American people, and the world population is getting squeezed due to inflation. Increased in costs, hotel, vacations, food, gas, whatever you have it, things are getting more expensive. And demand is now weaker than the supply. So again, when I taught the executive masters in business administration people at the University of Arizona in the Phoenix metropolitan area, I was teaching economics. And I essentially, we're all focused on the calculus and finding supply and demand. But last year, we had a whole big thing of supply. Supply was low and the demand was high. Now it's opposite. We are getting inventory surpluses and the demand is starting to shrink because of what the Federal Reserve is essentially doing within the interest rate hikes and essentially causing interest rates to go up while inflation is going up. So retail investors and American people are essentially losing in both sides. So as inventories increase, like in Walmart, they're going to start rolling back prices. But the problem is that's going to cut their corporate profit. And we're going to be going over that right now soon. So what is the Federal Reserve, what are they planning on doing? So they're looking at the core PCE, which ignores energy and food, and they want it to go down to a target of 2%. Currently, we are at 4.9% approximately from April's report. Now, inflation is going to start coming down. We already see it tick down. Companies are going to be cutting prices. Used car prices are decreasing, which, as you know, they've been increasing on a rapid scale. Companies are trying to get rid of their inventories. Therefore, they are going to have to cut prices, guys. And you're going to see a lot of these price cuts, and then prices start to come down. And that's the whole argument that's happening right now because of these inventories that are up 10%. Now, in the last video that Cathie Wood talked about, she talked with a wonderful lady from Piper Sandler. And these fund managers have been around during times of inventory surpluses. And the analysis that these former fund managers, hedge funds used to have is they used to take inventory and add it to the equation. And that was the how the global economy and how hedge funds were functioning. However, throughout 20 years, 30 years, people forgot to do that. And now you're getting these new fund managers who haven't experienced inventory surpluses that need to be added to the economic equation, which further subsequently affects the stock market. And you're having a lot of people hitting the books now and trying to relearn this while Cathie Wood is ahead of the game, right? So what does it mean when you have these extra inventory surplus? Well, I mean, they're going to have to start selling them off. You can't have all these excesses. So Cathie Wood's argument is 100% correct. These inventories need to be shelved off. And it's really great to see this because we are on track to what is going to be a deflationary phase. Now, what are the stages? Well, we were already starting to see companies putting hiring freezes. I mean, Facebook always hires, but now they stopped hiring software engineers. We're already seeing Netflix start to cut and other businesses even before laying off hundreds of workers on Zoom calls. Now, stage two, and we haven't entered this yet, is when profits continue to decline. We could see an increase in the unemployment rate. And essentially, what are people going to be doing? What are companies going to be doing when their profit margins start to go down? When their profits start to go down, well, they're going to be cutting operational expenses. And the easiest way to cut is to cut jobs. All right. And once we see that, and we do get an increase in unemployment, then we can start seeing that deflationary phase. So what is the end point of all of this? Well, the amazing sentence, and it's very critical to what we do at the Mastering Stock Market course, and when we find intrinsic value calculations, is that the stock market tends to discount the future, right? Therefore, once the stock market, this is what the stock market has to see. It has to see inflation decreasing and the Federal Reserve essentially stopping their tightening and stopping their increasing in rates. We already know that the Federal Reserve is going to be increasing their tightening approximately $45 billion for the next 3 months. And then subsequently after that, increasing their tightening by over $95 billion, right? So what does this mean? Well, value stocks are going to suffer. They're going to be value traps. And growth stocks will become the next phase, right? So right now, inflation is essentially the biggest concern, but not really. The stock market, more specifically the bond market, is starting to basically get senses of now inflation is not going to be the problem. Growth is going to be the problem. Growth is going to be the main issue that we're going to have, and I'm going to show that. So therefore, true growth companies, once this deflation period cycles in, are going to outshine traditional value stocks, ladies and gentlemen. And companies with strong revenue growths, typically over 20%, they will be rewarded handsomely. And if you look at Clover Health, well, we know that their growth is off the charts, okay? So what do I mean by inflation worries transitioning with inside of growth worries? Well, as you can see here, we're starting to see a shift here in April where inflation is no longer going to be the concern because the Federal Reserve now has become very hawkish. Now we're worried about growth with the surplus of added inventories hurting profits, corporate profits. Now we're going to be seeing these tech companies outshine because their growth is going to be okay. And that's where Wall Street's going to go. Wall Street is like a caveman, archaic slow-mo of a mover on investing. And as a retail investor, you don't have clients to please. So you're able to move in out of positions really to maximize your profit without having to explain it to somebody, right? So essentially, what am I talking about? Value versus growth. Well, as you can see right now, from after the 2008 financial crisis, value stocks, Warren Buffett, Benjamin Graham, the people I love and adore, that I base the Mastering Stock Market courses, intrinsic value calculation with the hint of growth value calculation. We tend to see value stocks outperform during times of economic disaster. However, after when things start to heal up, we start to see growth stocks tend to beat. Currently, we're in a phase where value is outperforming, which is what I pressed in November. But now we need to start changing. That's why I said healthcare and technology. Again, I'm going to say it again. Healthcare and technology, okay? So what does this mean? So I drew this graph, and what is it saying? Well, right now we're undergoing inflation. GDP was rising and still is rising, and CPI is rising. However, now we're going to, and obviously value stocks have been increasing. Wall Street is wanting to look at companies with positive free cash flow and positive net income that are profitable. But then growth stocks have been on the decline. So my job was to find stocks that are on the verge of becoming free cash flow positive and net income positive, but have still not matured yet to their big bucks, which then you were able to get it at a very heavily cheap discount, which is why it is a wonderful time to purchase right now. Because once deflation happens and inventories are so high where Walmart and Target has to reprice and roll back prices, you're going to start seeing GDP and CPI fall down together. And once that happens, you're going to be getting an inversion of growth and value stocks, where now you're going to start seeing a bunch of followers, sadly, followers start going in and pressing in growth stocks and surpassing it through its intrinsic value, past its intrinsic value. And then people like us that are well informed in the market, people in our Mastering Stock Market group and our private Discord channel, we're going to be ahead of the game, and we're going to be making money on both ends of the spectrum. So if you like this analysis, we pretty much just summarized Cathie Wood's 45-minute presentation in less than 13 minutes. There is going to be an expiring coupon code down below for our Mastering Stock Market course, which includes all of our calculators, our intrinsic value calculator, our sell calculator, our stability calculator. It essentially tells you when to sell stocks, when to buy stocks, and it gives you all of this information from an educational perspective to help you outperform the market. And this is lifetime access. We also have a subscription package where you can use our artificial intelligence technology. But guess what? Currently, since this is in beta access, the Mastering Stock Market course includes lifetime access to our stock alerts. So take advantage, because we will be removing that in the future. And everyone who enrolled before will be grandfathered in for a lifetime. We have been featured on Bloomberg Market Watch, NASDAQ, Benzinga, Yahoo Finance, Yahoo Money, and many other reputable programs. And it is an honor and privilege to have their support because we are trying to revolutionize how retail invests, because the educational system within finance, even at the graduate level, is laughable. And many of the top MBA programs don't teach correctly about value investing. So we're going to be basically solving this issue for retail. Okay, so let's go ahead and go over questions, and then we'll conclude this live. Hey, Doc, hope you're I'm feeling much better and did not need an aggressive. No, none of that. I tested negative for COVID. I think it's just the flu. Thank God. Just waiting for the golden days of the stock market. Oh yeah, it's coming. It's coming. I think the recession will be backlogged. Hey, word up. Recession 8 got nothing on Clove. Exactly. Insurance, again, healthcare and technology. All right, guys, I hope this was a very informative video. Again, you may have to rewatch this another time, like a couple more times maybe, because I did compact a lot of information here, and I wanted to give you it in a nice little vaccine dosage. And I know you don't want to hear the word vaccine probably. You guys probably need some therapy after what we all went through in 2020. God bless you all, and I'll see you guys on the next one.